Welcome back. You're watching our special show, Market Masters, and we're in conversation with the top team at PPFAS Mutual Fund, Rajeev Thakkar, Raunak, Onkar, and Mehta. Rajeev, you told us earlier that the market doesn't bottom out at the same time, the entire market. Some stocks may have already bottomed out and opportunities have started to come in. So incremental cash, where are you deploying? What is the team buying right now?
So far the buying has been in spaces where we already own positions. So for a long time we have been liking the banking and financial services names. So we have been owning 4 private sector banks, and those have been things that we have been buying. We have been, as would be seen from our February portfolio disclosures, we have added positions in some of the auto names that we have, or the public sector companies that we own, or in the pharma companies that we own. Largely it's been the same names. In December and Jan we added a couple of new names to the portfolio, but those are the places where we have been deploying.
Financials. What about IT, Rajeev? Is that an area you like? It's a bit of a non-consensus view.
So in IT, there are multiple reasons to be concerned about, but at the same time, longer term, these companies have been well governed and have been generating a lot of cash flow, etc. So one of the big concerns in IT has been around this role of AI in coding, and how much of an impact there will be on the number of people required and the IT budgets of various companies. That has been one area of concern. The other area of concern has been this accelerating trend of large foreign companies setting up their global capacity centers in India and directly employing people rather than going through the listed IT companies. And the third, of course, has been this new regime change in the US, and what will that do to visas and offshoring and things like that. So various concerns have been there. However, the companies in India have had a track record of managing various challenging environments. So we are neither too optimistic on this space, nor are we completely down and out. It's somewhat of a neutral stance here.
Raunak, what has made you all incrementally more bullish on autos, PSUs and pharma? These are the 3 sectors apart from financials, which is pretty much a consensus on account of valuations. But what has made you incrementally more bullish in the month of February?
So in the auto space, if you look at the domestic auto market, it's in fact a very small market compared to some of the global markets. In a country of size of India, we have a very low auto penetration. That has been the longer term trend which has been captured by some of the domestic players who have built the manufacturing capability in India. They understand the domestic market very well, and what kind of products are being bought by Indians. These kind of products are launched by these companies. Whereas if you've seen many of the foreign companies in India, they've not been able to scale except for one player at a meaningful rate in our country, because it's a very cost conscious and a feature conscious market. And that's a unique thing about India, where if you have built an expertise to make in India, to service in India, and also to provide a new innovative product lineup over a period of time with all the safety and price considerations, I think that is a skill set good with the Indian automakers. That's what made us conscious about the opportunity here. At the same time, the company we added, Mahindra & Mahindra, is not just into passenger vehicles. They're also into farm equipment like tractors. They're also into IT services. As a conglomerate, they have been doing a lot of cleanup over the past from capital allocation point of view, and the growth from some of the segments that they operate is also quite positive. So we own a couple of them. We own Maruti Suzuki and we own Mahindra & Mahindra in the auto space. In the pharma space, Reema, essentially it's a basket of pharma stocks. It's not a sector where we are bullish on a particular company, but the way we have been buying these companies is on the back of the tailwind of generic drugs exporting over a long period of time. And India has a capacity and capability of marketing and selling these drugs across the world. And they also cater to the domestic market, which is also growing at a faster rate. So these trends, if you combine across multiple companies, We don't need to pick a single company where the risk of FDA warnings or import alerts can hamper their profitability. But if you build a basket of such companies who have similar characteristics, good balance sheet strength, capability of marketing across the world and even domestically, I think these companies provide a good diversified way of investing in pharma space.
Got that. Rajeev, you used to own Indraprastha Gas, right? But I think you sold that name when the APM gas allocation rules were changed. But cities still do need gas distribution, right? It's still how are you thinking about that space? Stocks, of course, have corrected quite a bit.
Sure, Prashant. So there have been 2 or 3 points which create a lot of uncertainty. One, of course, is the APM gas allocation. The other was around how much profits these companies should be allowed to make. So there were statements from the regulator and from the minister. So that again creates this uncertainty and overhang. The third important thing, since you mentioned specifically Indraprastha Gas, not that we own it or we have any strong view about it, but again, in the media, there have been statements from various authorities saying they want to convert the transportation market in the National Capital Region to electric vehicles soon, so that the pollution levels come under control. Now, that directly hits at the large CNG market in which this company operates. So I have no idea as to when these things will happen, or is the stock attractive enough to buy or not. I don't have a specific view on that, but there are these few factors which are an overhang on the overall environment.
So much change and so much disruption, right? I mean, you own, I think you do own Mahindra & Mahindra in your portfolio, and they are partnered with BYD for their batteries, I think. And BYD yesterday came out with this 5-minute battery charging system. Time taken equal to sort of filling up your car with petrol or diesel. I mean, so it kind of could be an inflection point. But again, I mean, what does that do? When is the question? What does that do to industries like, refining? And so lots of implications which will play out in the coming years, Rajeev. Do you think the rate of change in terms of disruption has picked up quite a bit?
Yeah, I think the only constant will be change and at an accelerating pace. So we have seen this in the way people transact. So the whole UPI and the fintech ecosystem that has come about, the e-commerce, quick commerce, the gig economy, ride hailing, transportation of energy, transportation shifting from internal combustion to EVs, the energy use itself, the pickup in solar and wind over the fossil fuel led power generation. So plenty of change. As you rightly said, one will have to arrive at judgments in terms of which are the companies which will be able to make the transition and which are the companies which will fall by the wayside, and at what pace the transition will happen. Being too early also can be damaging, and being too late also can be damaging. So one has to time the transition well.
Raj, the optimism on banks also stems from the regime change at RBI, the recent liquidity bazooka, expectations of rate cuts. So valuations aside, what are you all expecting from the RBI and the macro indicators?
So very difficult to predict what the RBI will do, but broadly, if you see the measures that they have taken to improve liquidity, be it open market operations or be it dollar-rupee swaps, from an inverted yield curve, we have moved to a flatter yield curve now. So the shorter term rates have moved down a little bit. But going forward, we expect the short-term rates to move down a little more, whether it will happen in the next monetary policy or after that. But in the calendar year 25, we expect the short-term rates to be softer than where they are right now. And it will move to a more of a normal yield curve that it used to be 2 years back. So that's where we see the interest rates moving.
Okay, well, more questions, but as always, we are paucity of time. Raj, Raunak and Rajeev, thank you very much, all three of you, for sitting down with us here at CNBC TV18. An interesting conversation. I hope the one of many that we will have over the sort of coming months and years as we track the changes in many of these industries that we discussed. Thank you very much for being here on this program. We'll take a quick commercial break here. We continue with the regular programming on the other side. Stay tuned.